Welcome to Friends That Invest. You're joined today by your host, Sim. I'm a financial author and investor, and I'm here to help you learn all things about investing and personal finance. I am so excited about today's episode because we're going to cover every single stage of your investment portfolio and all the mistakes that you want to avoid. And if you know them now, then you're going to be set up for so much more success because you're not going to make the mistakes I made when I had $1,000 invested, when I had $10,000 invested, and then when I eventually had $1 million invested. When you start off investing, if you do not have the right tools and the right understanding, you will make mistakes. That's just part of the journey. It's just what happens. But if I can save you those mistakes within a 20-minute time frame, then I'm going to be a happier person and hopefully you will be a wealthier person. And I think that's a fair trade to give. So without further ado, here's what a sensible investment portfolio looks like when you have your first $1,000 invested. It is such a scary time to be an investor. And my investment portfolio, when I first began, was made up of two main index funds. It was VOO and VT. VOO is just an S&P 500 fund, invests in the top 500 companies in the States. Super simple, super boring, super easy. And VT was a total world market fund, which I did not realize at the time, but had a huge overlap with VOO, but it was a total world fund. And so I was like, yes, I've got exposure to overseas companies, and I've also got my S&P 500. And then on top of that, because I felt so confident at the time, mind you, this was many years ago, so just, go easy on me here. My one individual company that I invested in my satellite portfolio was Amazon. And Amazon was actually my first investment that I made. And then I added the index funds afterwards. Now, when it comes to investing, the first $1,000, the mistake that we see a lot of people make is that they just cannot even decide which broker to invest their first $1,000 with or their first $100 with. And they get really caught up in it. They're like, Sim, do I go with Fidelity in the States or eToro or Sharesies or Hatch, or do I go with this company or that company? And the truth is, at your $1,000 portfolio milestone, it doesn't really matter too much who your broker is with, as long as they're one of the top 3 brokers in your country. As long as they offer international shares, as long as they're a broker that has been around for a while, they're not like a new startup, and as long as they have some sort of insurance policy where they say, hey, up to $200,000 or up to a certain amount of money, we will ensure your shares are kept safe so that if something happens, if we get hacked, your money doesn't disappear. That's the main 3 things that you need. You don't have to worry about too many different things at that point, because if you're worried about which broker is the best, which one has the best foreign exchange fees and this fee and that fee, you will overwhelm yourself and you will not invest, and you will go another 6 months to another 12 months without investing. And that's just not what we want. Now, the second thing that you want to do with this $1,000 portfolio mark or milestone is you want to set really, really good habits. Now is the time. I love the saying, if you can't manage $1,000, you can't manage $100,000 or $1 million. And I think it's so true. When you have $1,000 invested, you probably think it's not a big deal. I'm not even a real investor. Not true. You're a real investor. Do not be hard on yourself. And you kind of don't think it makes much difference how you behave. But now is the time to set in really strong financial habits that are going to carry you through for the rest of your life, because it is so much easier to make and form good habits now than to break bad investing habits when you eventually have more money invested. So what are good investing habits for the starter portfolio? It's dollar cost averaging. It's not checking your portfolio every single week. It's making sure that you're investing in just an index fund or an exchange traded fund and not really worrying about other things. Just even starting with one fund is a good place to begin. And if you can get those down now and not worry about the brokerage and not worry about what's going on in the market, then that's going to set you up for so much more success which then leads us to chapter 2, the second huge milestone, which is when you have $10,000 invested. Now, the thing that stumps people at the $10,000 portfolio mark, and by the way, when I say like a $10,000 portfolio, I'm not saying you have put $10,000 worth of cash in your portfolio. Maybe you've put in your $1,000 and you're just putting in a couple of $100 every single month, and over the years that portfolio grows to $10,000. So we're here, we've got a portfolio. What are the things that people tend to get wrong at this point? There's two things that tend to happen, and I'll also share what I was investing in at that point in time. The first is you do need to start thinking about the brokerage that you are with. What tends to happen is if you're investing in a brokerage that has maybe a percentage-based fee on every single transaction, then if you invest $100 every couple of months, then a percentage-based fee is not a huge deal. Or if you're investing like $10 per month and you have a 1% fee on it, then that's fine. Like, I can live with that. But if you're investing $1,000 or $500, then a 1% fee on that really starts to add up. And so now a percentage-based platform might not be the best platform for you. So we're going to start doing some shopping. We're going to start looking around at other brokers, and we're going to start going to a brokerage that maybe is a better place for your money long term, because now you're, becoming more of a serious investor in your own head, and you want to feel like a serious investor because then you'll actually take your investment seriously and you won't treat it like a savings account where you just pull money out, willy-nilly. We are going to make sure that we have a brokerage that has low fees, but still hits all those other marks that we mentioned. So good insurance policies, not a new brokerage, and at least like a top 3 brokerage in your country. It's somewhat easier to transfer your shares over to a brokerage nowadays because most brokerages will have something on their website like, hey, are you with so-and-so and you want to move over to us? Like, let's help you move over. And so in my own life, with my own partner, I helped them move over their brokerage to one that was better with fees, just because they'd invested a little bit more, and over time they started to go, like what I'm with now, the fees are just too high. And so moving over has allowed them to just save so much more on fees. I know I'm talking about fees a lot, but it compounds. It really starts to eat into your portfolio if you are in the wrong brokerage. Now, the second mistake that investors make at the $10,000 portfolio mark, and this is something that I have done, we start thinking that our backside doesn't smell. Is that the right saying? I actually don't know. Your crap doesn't stink, something like that. But we start thinking like we know everything. We start thinking that we're just like really good. And we start taking more individual punts and investing in individual stocks and straying away from the tried and true method of investing in broad market index funds. So I went through this myself. Like, I will put my hand up and be the first to say that for this episode, I went back and looked at my portfolio, and I looked at what I had invested in at my $1,000 mark. I looked at what I invested in at my $10,000 mark. And I was really surprised because, guys, this is a no judgment zone. So of course I had my VT and I had my VOO, my broad market index funds, but some of my satellite portfolio funds were my IPO stocks of Airbnb. I also had meme stocks. I had GameStop and AMC, and I had tech companies. I had still my Amazon. My Tesla shares had done well, and I think at this point I had sold my Tesla shares, but I had bought NEO shares, which ended up doing really poorly. And I had Apple shares, which I still have to this day. My Apple shares have done well for me. But you can see it is just such a random collation of companies. And I think I got really overly confident about what I thought would do well, like doing well in Tesla and then thinking, well, I'm good at picking electric car companies. Let me invest in NEO. Let me invest in Rivian. Whoops, I lost like 80% in my Rivian shares. Whoops, my NEO shares did not do as well. I had to sell those down. Whoops, my IPO shares and Airbnb didn't end up doing as well. And so all these things like put together made me realize that a lot of my investing was starting to hinge on FOMO investing as opposed to like tried and true dollar cost averaging, putting it in broad market funds. And I do believe it is so okay to have a couple of shares that you're just kind of speculatively investing in. We're human. We can say like, abstinence is key, but the truth is you will not listen to me and you will do whatever you want. And so I'd like to say, practice safe investing. Just put 5% of your portfolio into these speculative stocks. But at the time, from memory, I think this portfolio that I had was slightly inching more than 5% of my $10,000 portfolio. So that's, a time and a place that I was in, but we move on. The next thing that you want to do when you reach that $10,000 mark is making sure that you're investing in tax advantage accounts. Now, this is so country dependent, but most countries from the US to the UK to Canada, most of our OECD countries, they offer tax advantaged accounts for your investments. You've got your stocks and shares ISA, for example, in the UK. Australia doesn't really have this, but they let you salary sacrifice. And so you have like a pre-tax portion of your salary that you can invest in shares, and you can actually, choose where your super money goes into. New Zealand, they're kind of like a tax advantage account. Like, what is that? We don't know. We're still like trying to get high-speed internet here. But what you will find is that some places offer these. So you need to make sure that you are aware of them, because if you can save a little bit on tax with your investments now, again, $10,000 doesn't sound like a lot, but what if that money over time turns into $100,000, turns into $200,000? $300,000, the tax advantage accounts make a huge difference. So look into that, make sure that's all set up. And if you do those just couple of things like having the right broker, choosing the right tax advantage account, and not FOMO investing, then you're going to save yourself a lot of headache and a lot of heartache when you see your shares drop. Now, I wasn't going to add in this $100,000 portion, but I feel like it is a huge part of investing. And maybe the jump from $10,000 invested to $1 million was just a little bit too high. But once you hit $100,000 invested, that is when you will realize just how much the power of compound interest makes a difference. Because suddenly, if your portfolio returns 7% that year, 7% of $100,000, that is a lot of money. 7% of $100, you're like, cool, I've made $7. That's nice. But when you start seeing the impact on what happens to a large portfolio, you just start to see like, oh, this is what's meant about compound interest, because now I've not just made 7% of $100,000 in my first year, the year number 2 of my $100,000 portfolio, I've made a 7% return on my initial $100,000 and the compound interest that I earned last year. And so that's really going to start taking effect, and you'll start seeing that exponential curve. You'll start seeing the exponential curve begin a lot more, and you'll be like, oh, this makes sense. And when you look into the math, you see that a lot of people will share this idea of like the $0 to $100,000 portfolio is actually much harder to get to than the $100,000 portfolio to $1 million portfolio. And I agree, because once you have that first $100,000 invested, as long as you don't pull that money out, as long as you continue to keep investing, and as long as you are in broad market index funds and you have a long time horizon, then very quickly will you start to see the journey from $100,000 to $1 million invested, which then leads us on to the $1 million investment portfolio. Imagine being there. That is such a huge achievement. And I know that we have some investy besties in our community that have reached that number already. And to that, I say, what a huge, huge achievement. Like, congratulations. We've had investy besties that have gotten this portfolio from a range of ways. Some of them have worked at startups and had exits. Some of them have had their own businesses. Some of them have just worked really hard jobs where they've also had really high salaries and worked their way up in a corporate career, regardless of the way that they've achieved it. We've had a range of people in a range of ways that these women have achieved $1 million investment portfolio. And there's a couple of things that happen at this point that even if you're not there just yet, you should know and you should be aware of, so that you can, like, when you get there, you're not freaking out. You're not like, oh my God, what do I do? Do I just like cash it out? And like, oh my God, I just freaking out and now I have a pink Porsche in my driveway. That is not where we want to end up. We want to have decisions that we have made because we are smart women and we have planned ahead and we know exactly what we're going to do, where we're going to do it, and who's going to help us. So the first thing that you're going to do when you hit that $1 million investment portfolio, which is huge, and besides having a little party, you're going to decide, is this the point that I stop investing? Or is this the point that I keep going? Because you might decide, actually, based on my lifestyle, maybe I live in a high cost of living area. Maybe I have 4 kids. Maybe I have all these other things that are going to cost me money. And therefore $1 million is not enough for me to retire off. So let me continue to just keep investing. I'm still putting my money in broad market index funds, and let me just keep going that way. We can keep doing that. The other option is when you decide, is this the time that I start to draw down some of my investments? Do I pull down 3% every single year and have $30,000 as an extra income, which would be really freaking nice? Does that mean that I slow down working, or I maybe work a couple of times a week rather than a full week? What does life look like for me? And because you're starting to think about selling down some of your shares, that then brings up the question of tax drag, which means, are my returns actually the returns that I'm expecting, or is tax something that I'm putting into account? Especially if I live in a country like New Zealand where I have FIF tax or PI funds. The other thing to consider is when you live in countries like the States or Canada or Australia, where you have capital gains tax. And so there's a few different things to consider. And this is probably where a tax accountant is super helpful. Maybe you don't need one when you have $1,000 invested, but you got $1 million invested. You can afford a tax accountant. Go talk to someone. They're going to be able to really help you, because at the end of the day, I am not a tax professional. The second thing that you're going to do when you reach $1 million investment portfolio is you have to understand that if you are going to start to sell down your shares, you don't necessarily want your entire investment portfolio in stocks. That is quite a highly risky investment portfolio, because even if they're in index funds, what are index funds made out of? Shares of companies, and companies are volatile. And one would argue that they even feel more volatile currently than they have ever been. And so you might want to look into rebalancing your portfolio. And that's when you go, Sim, when I had $10,000 invested, I was in my 20s or I was in my 30s, and I had, 90% portfolio in stocks and maybe 10% in bonds. Now I am in my 50s or my 60s or my late 40s, and I've decided that I'm going to live off these shares. So I'm going to have maybe 50% of my shares in just S&P 500 and another 50% in bonds. The percentage weight really depends on how close you are to retiring or living off that money. And if you want to live off that money now, the more you have weighted towards bonds, the better, because you're not having that up and down in the market. Imagine if you needed that money next year, and then rather than that share price going up 7%, it drops 5%. Are you going to draw down money at a negative 5% return? That is just stuff of nightmares. And so the closer you get to your goal, the more you're going to start rebalancing your portfolio. And again, a fee-based financial advisor at this point might be quite helpful, because maybe you're not retiring yet, but you want to pull down some money and you don't really know how much to balance it. So that's where you might find a little bit of help in that place. And the next thing that you want to think about is alternative investments. You don't have to do this. I just think it's a little bit more fun. And so when I reached my investment portfolio of over $1 million invested, that gave me the chance to become an accredited investor or a wholesale investor, depending on where you live. It's the same thing, different terminology. And it means that you have enough assets to allow you to take on much larger levels of risk. And so that looks like investing in startups, angel investing, venture capital investing, private equity investing. It looks at growth equity investing. There's so many more vehicles of investments that you can make. Maybe, commercial property, not that you need to be an accredited investor to do commercial or to do residential property investing, but you have a more solid base to get started into these kind of things. And of course, it would not be a Sim episode without me giving a disclaimer that if you are going to be looking into these alternative investment vehicles, they have some huge levels of risk. There's also some much larger returns that can happen, but there's a reason that governments say, hey, sure, like Sim, you can invest in this startup, but you have to be an accredited investor because the likelihood of the startup failing is so high. The likelihood of it doing well is so low. We don't want you to lose meaningful money, but if you're a millionaire, then sure, maybe put $5,000 into this. It doesn't work out, you'll be okay. But we would not let, like, Sim, who had $10,000 total, we would not let her invest $5,000 into a startup because if that drops, that's 50% of her net worth being lost. That's a no-go zone. We're not happy with that, which is, important, and I respect it. And the final thing that you want to do when you reach this investing portfolio size is you want to start thinking about estate planning. I would actually argue that estate planning, like just a simple will, is something that you should be looking into when you have even $10,000 invested, but you will be surprised. You'll be shocked. And if you're a lawyer, you will be distraught at knowing how many people do not have wills despite having a very large investment portfolio. And when I say very large, I'm meaning like $10,000 plus. That's a decent amount of money. And that's money that people will fight over, and it will get messy if, like, God forbid, touch wood, something happens to you before your time and everyone's grieving. And then also it's like, I'm really sorry to hear about Sim. Yeah. Did she leave any papers behind? Like, can you just imagine that conversation? It would just be so distraught. And so putting something in place, you can just go to a lawyer, like search up like a flat fee lawyer that will do a will, super cheap. You don't have to spend a lot of money. Though I will say, if you got $1 million invested, like, just spend the money on the lawyer, spend the money on the accountant, spend the money on the fee-based financial advisor. When you start having money that is life-changing and can change other people's life, including children or spouses or anyone, you just need to have it like all clear, super clean, print it out, put it away. Like, this is how I want the conversation to go for me. Oh my God, it was so sad. Like, Sim was so amazing. She was beautiful. Like, her skin was really glowing, even though she, kicked the curb in her 90s. Oh, it's so sad. Did she leave any papers? Yeah, no, she always told me she had something in like the top drawer of her office. Done. Easy, simple, clean. Do you know what I mean? And so once my investment portfolio reached the $1 million mark, my investments started to diversify a little bit more. So yes, I still have my core portfolio of shares, specifically index funds, and with index funds, specifically the S&P 500. I practice what I preach. And then I also have a couple of individual investments, like individual stocks, but not hugely. And at the current point in time, I've actually sold a lot of them down. And then my investments spread out into individual angel investments that I've made in startups, a startup syndicate of like an angel syndicate with some female investors that I have, and investing in venture capital. On top of that, I also have 2 rental properties, and I'm looking at investing possibly in commercial property. So now I've got my fingers in lots of different pies. And that's a good thing to do because diversification gets more and more important as your portfolio grows. So like at the start of 2026, when the share market was getting a little bit crazy in the US, I remember thinking to myself, like, this is annoying. My shares are dropping because these are my S&P 500 shares in the US and I just don't know what's going on there. But I also have property in New Zealand, which is a very stable and safe country. And so I'm not too worried about the risk because I have almost like diversification amongst countries. I guess that's exactly what it is. And so I'm able to like separate that out. Now, that's not really something you have to worry about when you've got your first $1,000 invested, because if you're worried about like currency risk and geopolitical risk and brokerage risk and diversification risk, like you will be so just overwhelmed with risk that you won't invest anything. And you can therefore see the different levels of investing from your first $1,000 to your $10,000 to your $100,000 to your $1 million investment portfolio. There's so many things that people can get wrong, but because you have listened to this episode, you know what to look out for. And you can always come back to this when you reach that next goal and you're like, oh my God, I've done it. Like, how good. Now I've reached $100,000. I know what I need to do. Thank you so much, Sim. Like, let's just keep on growing our investments. Like, how freaking cool is that? And so I hope you found this episode helpful. I hope you've been able to walk away with something. And as always, please, please, please like, share, subscribe, take a screenshot, put it on your Instagram story, tag friends that invest. It is the best way for us to help the podcast grow and reach more women that want to get better with money, because what more can we ask for than a world where more women are financially educated? And so with that, I'll see you next week.